So let's talk about two words that, don't always sound like they belong together: crypto and regulation. For years, it's felt like this big, messy fight between innovation and control. But what if the whole point wasn't to stop crypto, but to actually give it a clear set of rules so it could finally go mainstream? Okay, let's get into it. You've probably heard this a million times, right? The idea that any regulation is going to crush the whole decentralized spirit of crypto. But here's the thing. A lot of people inside the industry, from developers all the way up to huge investors, have actually been asking for rules. So the real question is, can we get that clarity without killing off the innovation that makes this space so exciting? All right, so here's what we're going to cover. First up, we'll look at the big problem that crypto's been dealing with. Then we'll really unpack what this Clarity Act is all about. After that, we'll see how it rewrites the rulebook, who the potential winners and losers are, and finally, we'll take a look at what this all might mean for the future. Okay, so before we can really dig into the solution, we've got to understand the problem. And it's a big one. For a long time, people have called the US crypto scene the Wild West. And honestly, they're not wrong. The biggest headache has been this whole idea of regulation by enforcement. Imagine trying to play a game where the referee only tells you the rules after you've already broken them. That's kind of what's been happening. Instead of having clear laws, you've got these two big agencies, the SEC, who handles stocks, and the CFTC, who handles things like gold and oil, making up the rules by suing people. It created this huge mess where nobody was sure who was in charge or what was even legal. And this quote from Coinbase just absolutely nails it. The whole issue really boils down to one simple question with a ridiculously complicated answer. What, legally, is a crypto token? Is it a security, like a piece of a company? Or is it a commodity, like a barrel of oil? Because nobody could agree, everyone, from the builders to the investors, was just operating in this giant gray area, kind of hoping they weren't breaking a rule they didn't even know existed. Now, while all this regulatory chaos was happening, something else was going on in the background. Wall Street got really interested. I mean, just look at this timeline. We went from banks telling everyone to stay away from Bitcoin in 2013 to giants like BlackRock filing for a Bitcoin ETF. The big money wanted in, but they weren't about to jump into the Wild West. They needed a rulebook, and that pressure became impossible to ignore. Which brings us right to the proposed fix for all this mess, the Digital Asset Market Clarity Act. So, what is this thing, really? At its core, the main goal of the Clarity Act is pretty simple: to end that whole regulation by lawsuit game. The idea is to finally write down the rules of the road in one place for the entire country so everyone knows what's what bucket their asset falls into, and which agency is in charge. And here's where it gets pretty clever. The Act recognizes that not all crypto is the same, so it breaks everything down into three main buckets. You've got your digital commodities, your investment contract assets, and your stablecoins. And each one gets its own set of rules and its own referee. First up, we have digital commodities. Think of your heavy hitters here, like Bitcoin and Ethereum. The law basically says these are essential to how their own blockchain works. Their value comes from being useful on that network, kind of like how oil's value comes from all the things we use it for. These would be overseen by the CFTC. Then we have this second category, investment contract assets. I know it's a mouthful, but just think of ICOs, initial coin offerings. If a team sells a token to raise money to build their project, this act says, hey, that sounds an awful lot like selling stock to fund a company. And because of that, it falls squarely into the SEC's territory. Okay, now this might be the most innovative part of the entire bill. It's something they're calling a graduation path. It acknowledges that a crypto project can evolve. So it can start out as a security under the SEC's watch when it's just a small team raising funds. But if the network becomes truly decentralized, and they actually put a number on it, less than 20% control by insiders, then the token can graduate to become a commodity regulated by the CFTC. Pretty cool, right? So we've got the theory, but what does all of this actually look like in practice? Let's do a quick before and after comparison, because the change is, well, it's pretty dramatic. This table really lays it all out. We go from using this old subjective legal test from 1946, the Howey test, to having clear modern definitions. That whole turf war between the SEC and the CFTC, it gets sorted out with the CFTC taking charge of the spot markets. And that vague idea of being sufficiently decentralized gets replaced with a hard number, that 20% insider control test. It's a shift from ambiguity to objectivity across the board. Now, anytime you rewrite the rules for an entire industry this dramatically, you're going to create some serious ripple effects. There are going to be winners, and there are probably going to be some losers. So let's talk about who's who. This quote from a key White House advisor really says it all. For years, the big traditional finance players, the banks, the investment friends, have been standing on the sidelines. Why? Because the rules were a mess. He's basically saying this act could be the final green light they've all been waiting for to dive in. And when we say dive in, we are not talking about a small splash. We are talking about a tidal wave of capital. Some forecasts predict that this kind of legal clarity could unlock a staggering $25 billion in new money flowing into just the Bitcoin ETFs in the first year alone. That shows you just how much cash is waiting on the sidelines. And look, this isn't just some wild guess about the future. The shift is already happening. Projections show that by mid-2026, institutions could hold nearly a quarter of all the Bitcoin in these ETFs. The institutional era is already dawning, and this law would just hit the accelerator. But, of course, there are two sides to every coin. On the pro side, you get the legal certainty everyone wants, you get the big institutions jumping in, and you get better protection for everyday consumers. That all sounds great. But on the con side, well, all these new rules cost a lot of money to comply with, which could make it really tough for small startups. There's also a real fear the SEC might get too much power, basically becoming a gatekeeper that picks which projects get to live or die. So if we break it down, it's a mixed bag. For the big exchanges and the banks, this is largely a win. They get legitimacy and a clear path forward. For investors, it means more protection from things like fraud, which is a huge plus. But for the developers, the builders, it's that classic trade-off. They get a safer environment to build in, but the cost and complexity of compliance could become a massive hurdle, especially for the little guys. And that brings us to the big picture. This act provides a map, for sure, but the road itself is still being paved. The future is definitely clearer than it was, but it's still pretty uncertain. Now, the really amazing thing is this bill actually has support from both Democrats and Republicans. You don't see that every day. But it's not a done deal yet. There are still some major arguments happening around the trickier parts of crypto, like DeFi and stablecoins, and those details could absolutely slow this whole process down or change the final version of the law. I think this quote is such a powerful way to frame this whole debate. The point here is that this isn't just about whether you love crypto or you hate it. It's about protecting people. The argument is that doing nothing, just letting the Wild West continue, is actually the most dangerous option for consumers. So you can see this not just as a pro-crypto bill, but as a pro-consumer bill. And so that's where we're left. The Clarity Act promises to finally swap chaos for order. It offers a clear path for big money and better protections for the rest of us. But it all comes down to this one central question. What's the true cost? Will the high cost of compliance and all these new rules end up stifling the very innovation that made the space so interesting in the first place? That's the billion-dollar question everyone is asking. I'd love to know what you think. Drop a comment below and let's talk about it.